Given the strength of our economy and the pace of recent price increases, it's appropriate, as the federal chairman, Chairman Powell, the Fed Chairman Powell has indicated, to recalibrate the support that is now necessary.
Central banks need to think very carefully, what can they achieve by raising rates, given the underlying cause of the higher inflation environment?
Wage inflation doesn't go back. I joke with our team, I can't remember an employee when things get, when inflation subsides, they come and say, I'd like to get part of my salary back. So, whatever we're having to do on that front will stay with us forever.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and this is what's coming up on today's program. NASDAQ correction. The tech-heavy index closes down 10% from its peak. Global stocks rise, and the U.S. futures point to gains as the bond sell-off pauses. Biden's warning marking his first year in office. The president says he expects Russia to move in on Ukraine. Plus, Boris Johnson holds on. The UK Prime Minister dismisses calls to resign as party loyalists close rank. Now, let's check into the markets, because actually we were seeing an encouraging sign of where they were going. Now we're seeing a little bit more pressure overall of what we're doing. Now, this is a picture for the European stock 600, down some 0.2%. They actually erased some of the initial gains as a global sovereign bond sell-off paused. Investors also turning their focus on some of the corporate earnings. If you look at what the European map is doing, again, a tale of different fortunes. So Unilever is definitely the one to watch out for after it said it abandoned a share price, or it abandoned buying another company. Now it's putting a lot of pressure on the chief executive of Unilever to come up with a new strategy. So the U.S. 10-year Treasury yield looking poised to surge past 2%, while the German peers turned positive for the first time in years. Now that's as traders lay bets on faster policy tightening from the Fed and other major central banks. Well, joining us now for more on the markets, Aaron Captain, Global Head of Economic Research at UBS, and our Bloomberg Markets Editor, Christine Aquino. So, Aaron, thank you for joining us. When you look at some of the things that we really need to focus on, is it all about the Fed and the fact that we could see a policy mistake? Because if the Fed hikes too aggressively, it won't necessarily deal with the kind of inflation we're dealing with.
Well, they would have to hike a lot more than what's priced, I think, for it to be a policy mistake. So if you do what's priced, I just don't think it's a very big shock on the economy. But to your point, these hikes are not going to do really anything, I think, about the underlying problem, which is a bottleneck problem. So, it would be much more effective, I think, if you look at where the pressure is coming from, to do something about the ports in LA, lift wages for truckers through a fiscal bill, and sort of try to get these ports unclogged rather than hiking, which effectively is going to be a mechanism to slow the housing market, which we think is already starting to slow.
So, Christine, what does that mean for where we should be looking at? I mean, there is a little bit of course, price action when it comes to treasuries, no longer repricing like they did in the last couple of days.
Absolutely, Francine. I think what my team is particularly interested in is really some of those nuances in the way that markets are pricing rate hikes moving forward. We're talking about not just in terms of the size of moves that they're expecting meeting to meeting, but also those longer term expectations. I'm talking about expectations for rates further out the curve, say 18 months down the curve. That's right now what we're seeing is where traders are expecting most rates for the Fed, for the ECB, for the BOE to peak, and then from then on, they're starting to price in a bit of a pullback in those rates. And so that's really where we want to be looking for when we're talking about policy mistakes here. And then to your point, any signs of expectations that at some point these rate hikes will start hurting longer term growth prospects.
So, Aaron, how many Fed hikes are you expecting this year?
3, but that's because we have a much lower forecast on inflation than the Fed. So I think if you take the Fed's forecast, it's likely they do 4 at the current baseline, and then I think the risk clearly skews to the upside that the next step is going to be that they would go every single meeting.
There was, one of the chief executives we spoke to, which was quite surprising, Christine, definitely an outlier call, saying he's expecting like 8 Fed hikes. I mean, we need to focus a little bit more on quantitative tightening and what that does to bond prices than actual hikes.
Absolutely, Francine. I think this is the other lever that the Fed has to really make an impact when it comes to this whole process of normalization. And I think something to consider here is that overall effect on the economy and on growth when you see the situation of simultaneous Fed rate hikes hikes, as well as that balance sheet rolling off process? And what is the aggregate effect of all of that? And I think that also will help us answer all these questions, again, of longer-term growth expectations and how the economy would respond when we're talking about not just one policy lever when it comes to rate hikes, but the second lever of the balance sheet mechanism.
So, Aaron, how much more of repricing are you expecting, for example, in treasuries, and what do they do to other asset classes?
Yeah, so we have treasuries going, the 10-year treasuries going to 2.1 by the end of the year. I think it's not so much the level you get to at the end of the year, it's the rate of change we're having right now. So historically, if you get a 40 basis point move in real rates over a period of 3 months, and we're getting it now in the space of 2 weeks, that's a threshold point at which things are just moving too quickly and other assets start to reprice. So this is a little bit of a dangerous point in the market. But in terms of going to 2.1 by the end of the year, I don't think that's a terribly big deal. On the balance sheet, I would say that is something we expect, and so starting with the decision in May and then starting in June, we think we're going to get $2 trillion in runoff. But the key point to make there is that it's the Treasury that will actually determine the impact. So it's true that mechanically there's an equivalence between that balance sheet roll-off and interest rate hike. So on paper, if you do $2 trillion, that's an additional 3 hikes on top of what you're doing through the policy rate. But if they start issuing more and more T-bills, which we think they will, then you actually mitigate a lot of that impact. So I think it's in the hands of the Treasury what the market impact is.
Aaron, I mean, there's a school of thought that says actually because they've, been sounding so hawkish, it's done a lot of the policy move for them, then they don't have to hike as much, and it kind of gets the job done because they're seen as dovish. I mean, is that, messed up thinking, or is this what we could be looking at?
So I don't think. I mean, I don't think they've really done that. So if you look at where where the terminal rate's priced, where their own dot is in 2024, the median dot, there's a lot more scope, I think, to price more through the dot plot and tighten financial conditions. The pace that they're signaling is still very slow relative to what they've done in some of these past cycles. So I think that's, we've had a lot of front loading, not just in the U.S., but hiking cycles have been front loaded into the first 2 years, and then sort of nothing after that. And I actually think there's a lot of scope to reprice sort of in the belly of the curve and push these terminal rates higher.
All right, thank you both for joining us. Christina Kina, there are Bloomberg Markets editor, and Aaron Captain from UBS stays with us. Now, coming up, Smart Conversations on Bloomberg Surveillance. We'll talk about the year ahead for markets with Anne Richards, Chief Executive of Fidelity International. Plus, we'll also get the latest on UK politics with Camilla Cavendish. That's all coming up. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now it's time for the Bloomberg Big Take, and soaring energy prices and rising inflation are causing policy headaches globally. Now the UK, however, has to deal with those, along with rising taxes and the ongoing effects of Brexit, kicking off an economic experiment in one of the countries worst hit by the pandemic. Well, we're back with Aaron Captain, Global Head of Economic Research at UBS. Aaron, are we underestimating the fact that when we abstractly call and talk about inflation or rising energy prices, it also means that people will struggle to do ends meet by the end of the month, certainly from April in certain countries, and that could change the composition of our economies?
Well, so the inflation, I think, spike is clearly hurting people, I think, particularly at the lower end of the income distribution. So real wages are now severely negative in many, many countries. So, yeah, I think there is an issue of having to make ends meet, and which is why I think central banks are reacting. They need to be seen to be doing something, even if they're not fully in control of the problem. But at the end of the day, I think the opening up dynamics that we're getting from the recovery that's happening during this pandemic are sort of going to neutralize, I think, a lot of those real wage headwinds. And so net, I think we're still in a very strong growth phase where on the whole in the year things get better. And then to your point, I think, if you look at the rates of change in the sequential rate of change in inflation, things are going to now start to get better. So even on the energy side, the rate of change is now starting to decelerate. And so as you get later into the year, I think the real wages are going to start to improve.
Aaron, what does it mean for what politicians and policymakers will put in place? And does that lead to a bigger debate, of course, on deficits and how we deal with a lot of this public debt?
Yeah, so I mean, I think there's been two main interventions. One is on energy prices, where there's just a lot of divergence across countries in terms of what different countries are doing. So if you look at the gas price spike in Europe, then there's been much more pass-through, for instance, in the Netherlands compared to a place like Germany. And because those the wholesale gas prices have come down a bit, but they're still quite elevated. So the immediate decision for government is how much to keep intervening effectively and breaking that link between wholesale and retail prices. And so that creates a lot of uncertainty, I think, for where headline inflation will go this year. So that is the most immediate, I think, decision to make. The other one is just the Omicron and the lingering sort of effects of this pandemic, where the furlough schemes have been extended, I think appropriately so. And so that's another form of sort of extending the fiscal stimulus and providing some income support.
Aaron, what do we do with China right now? So one of the biggest concerns was that if they were quite hawkish in terms of policy moves, it would also hurt the rest of the world. Are you confident that they're putting the right policy mix in place?
So I think they're doing enough to sort of stabilize the ship. So it's quite different from past cycles. If in past cycles, they would basically, through quantity measures, they'd flood the system with liquidity. And then really the property market was the big engine that was a way of pulling many different levers. And now it's very different, because now the problem is concentrated in the property market. So you're really just trying to stabilize things. And I think they're doing just about enough to do that. But if you think in credit impulse terms, for instance, what they're doing is about half of what they did in past stimulus cycles. So it's only sort of, I think, just enough to stabilize things. It's not some big acceleration in Chinese growth. And then the other point to make is that there's just a huge compositional shift underway in the texture of Chinese growth, which I think transmits much less well to the rest of the world. So if you're going into a Chinese growth model where the property sector contributes very little, that is less commodity intensive and less import intensive growth.
But is it some kind of, what does that mean actually to inflation then going forward, Aaron? Do you play it that way, or is it commodities that then could be used also in the energy transition? I'm thinking of copper.
Yeah, so I think near term, the net effect of that property slowdown in China more than neutralizes sort of the structural long run increase in demand for metals coming from some of these ESG sectors. If you look at our Chinese sort of metals forecast, then pre-pandemic, we had average annual metal consumption growth of about 5%. The next 5 years, we think it's 0%. So that is just a huge shift that the world needs to absorb, even if in the long run we have some of these other sources of demand which are going to start to pick up.
Aaron, what's do you do a lot more in terms of research about some of the idiosyncratic stories, for example, what the Fed does to some of the more obscure emerging markets, or is it just a story of volatility for 2022?
So I think there is, in EM, I think there's lots of idiosyncrasy, right? So I think there's lots of individual stories. It's no longer sort of one asset class moving in sync. I think the inflation dynamics in Asia are completely different from LATAM and are completely different from Turkey. And they're all going to have different sensitivities to these rate hiking cycles that we're going to get in developed markets. In terms of the volatility, I'm just really struck by the enormous dispersion of views that we still have for this year. Just on something like the Fed, I think for this year, there's a min-max forecasting range of something like 230 basis points. That is just an unusual level of uncertainty that I think is going to create a lot more volatility, I think, as we get into the year.
Aaron, thanks so much for joining us. Aaron Captain there, Global Head of Economic Research at UBS, joining us this morning. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Boris Johnson has rebuffed new calls for him to resign over alleged breaches of lockdown rules at Downing Street, just moments before the UK Prime Minister faced lawmakers for questions in Parliament. One of his MPs crossed the floor of the House of Commons, defecting to the opposition Labour Party. A report into the lockdown gatherings is being prepared by a senior official and could be published as soon as next week. Now, new research suggests booster shots lots of mRNA vaccines, such as those made by Pfizer and BioNTech, do not prevent infection with Omicron. Scientists focused on a group of German visitors to South Africa who experienced COVID infections despite having had a third dose of the vaccine. However, all the cases were mild or at least moderate, suggesting the extra shots helped prevent a severe disease. England is to lift most COVID restrictions over the coming days, with people no longer asked to work from home and mandatory face mask rulings dropped from next week. Prime Minister Boris Johnson says he wants to transition into living with the virus. Mandatory isolation for positive cases could be lifted by the end of March. And museums and theatres in the Netherlands have come up with a novel way to protest against what they say are unfair coronavirus measures. The Van Gogh Museum in Amsterdam opened as a hair salon yesterday, with other cultural venues offering gym classes. The Dutch government is relaxing restrictions on some businesses, but museums and theatres are to remain closed. Global news 24 hours a day, on air and on Bloomberg QuickTake, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
I love that so much, Leanne. What a wonderful way to protest. Also, I quite fancy a haircut with the symphony orchestra playing behind me. Now, coming up, President Biden says Russia may move in on Ukraine. We get analysis of Biden's comments and the tensions between Russia and Ukraine shortly. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, President Biden says he thinks Russian President Putin does not want a full-blown war, but will move in on Ukraine after amassing around 100,000 troops on its border. Well, after first suggesting that the U.S. might not respond as forcefully if Russia launches a minor incursion, Biden later sought to clarify that any invasion would have consequences.
But if they actually do what they're capable of doing with the force amassed on the border, it is going to be a disaster for Russia if they further invade Ukraine, and that our allies and partners are ready to impose severe cost and significant harm on Russia and the Russian economy.
Well, for more on the reaction to the president's speech and the unfolding situation on Ukraine's borders, let's go straight to Rosalind Matheson, Bloomberg's executive editor for international government. So, Ros, good morning. How will Joe Biden's speech on Ukraine actually be received in Russia and Europe?
Well, that's the question. Was he really, in a sense, articulating publicly what many people already know and think in private? And that's the reality that action by the Russian president against Ukraine, be it a fully fledged war, be it incursion in the east, be it destabilization efforts inside Ukraine, will all be challenging for Europe and the US in terms of how much or whether even they can respond. Europe and the US have ruled out military action themselves, sending troops, and that puts it really in the core of sanctions. And there we're seeing so far there's no agreement on what sanctions could be deployed specifically against Russia. So perhaps the US president was just articulating the complexities there and how to handle a potential move by the Russian president, even though mostly for now people have been saying that preferably in private. Saying it publicly does potentially give credence to the Russian president. Does it signal to him a green light that if he were to make an incursion, for example, that he'd be allowed to get away with that to some extent? So that does add that level of complexity to the discussions, the fact that he made those comments so publicly.
Does it weaken actually significantly the position of Europe and of NATO? And does it make a difference to then Vladimir Putin's thinking on what he'll do next?
It is a challenge for NATO because he also said, realistically speaking, that there's no chance of Ukraine joining NATO anytime soon. In fact, it's unlikely for years, at least, if ever. That sort of counters the NATO public statement, which is like any country can apply to join and our door is open. So it did arguably undercut some of those comments as well, and the idea of a unified approach of strength against Vladimir Putin. The real question is, what does it do for the US Secretary of State, who's meeting his Russian counterpart in Geneva tomorrow? And does that put him on the back foot as he goes into those discussions?
Yeah, and I was going to ask you, so Anthony Blinken will be in Berlin today. What is he trying to push for Germany?
Well, certainly he'll be sending a message that there's still a strong sense of unity. There's a determination to take strong action against Vladimir Putin, no matter what kind of action he might take against Ukraine. That's definitely the message you can expect today as he meets some of his European counterparts in Berlin before he moves on to Geneva, is to sort of try and send the message that they're all at one in terms of their level of concern about the build-up of troops on the Ukrainian border, and that they would be united also in their response. But that messaging is undercut, as I said, either way by what his boss said at the White House last night.
All right, smart analysis, as always, from our Rosalind Matheson, Bloomberg's executive editor for international government. Coming up, we speak to the Fidelity International chief executive, Ann Richards, a conversation I've been looking forward to all week. We'll talk markets in the year ahead with her, and of course, we'll talk about some of the yields that we've been seeing on treasuries. This is Bloomberg. NASDAQ correction. The tech-heavy index closes down 10% from its peak. Biden's warning marking his first year in office. The president says he expects Russia to move in on Ukraine. Plus, Boris Johnson holds on. The UK Prime Minister dismisses calls to resign as party loyalists close ranks. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's return to one of our top stories, Unilever giving up the race for GlaxoSmithKline's consumer products division. Now, the London-based consumer goods giant says it just won't raise its £50 billion offer for the business. Now, for more on all of this, we're joined by Danny Berger. Danny, I mean, this is a crazy story because actually we got a press release by Glaxo saying, look, Unilever is no longer pursuing this, and the share price kind of exploded, getting some 10%. So there's a real strategy problem here.
Exactly. The fact that shares gained so much and fell so much to begin with when they announced it just shows that people did not think that this was a strategic fit. Analysts put out notes saying, please don't. Very bad deal, almost uniformly negative, and shareholders voted with their wallets. The shares dropped 11% in just 2 days. So I think there's some leaf, but again, this calls into question. Unilever is trying to change their strategy. What exactly are they doing here? Are they pursuing the right deals?
I mean, is there going to be so much pressure from shareholders that the chief executive will actually have to come up with something new? Because there was also confusion about whether they'd, sell some of their healthcare business, or we actually don't know what we're looking at.
Exactly, and the move to London for Unilever was in part because of this, saying we're going to be more aggressive about acquisitions. We're going to look at divestitures, which might focus around our food operations. So they've sort of broadcast this more aggressive strategy. Clearly, shareholders did not like the path that they pursued, so it does call into question these sorts of things.
Danny, thank you so much. Our Danny Berger there with that really important story. Now, let's get back to the markets. And joining us now is Fidelity International Chief Executive Ann Richards. Fidelity International has some $780 billion in asset management. And of course, before joining Fidelity, Ann was Chief Investment Officer at Aberdeen Asset Management, Chief Executive Officer of M&G Investments. And one of my favorite people actually to interview, Ann, because you always make us smarter and you always think of things a little bit differently to everyone else. So thank you so much for joining us this morning. On inflation, have you changed your mind on how quickly central banks should move on? I think in December you said that they would have to be in a wait-and-see situation to have some concrete data before they acted.
I think my take, and by the way, it's good morning. It's great to see you again, Francine. It's just lovely to be here again. I think that the point that we've been quite consistent of for quite a few months now is that the risk of a policy mistake by being too hawkish was probably the bigger risk on a balance of probabilities, which is not to say that there aren't quite significant challenges in the inflation picture. And I think we probably stand by that, particularly now when you see that we've got this tension between, yes, rising inflation, but at the same time, some real signs that maybe the growth picture is not quite as rosy as it was 4 or 5 months ago. And that's a combination of Omicron, but just the way the whole supply chain challenges have played out. And I think if you're a central banker right now, you're in that kind of catch-22 situation because you don't want to kill growth, that might already be under some pressure, but at the same time, you've got this big challenge on the inflation front. If you unpick the inflation challenges, they're quite different in different parts of the world. I mean, one of the things I think is very striking is the fact that inflation numbers look much worse in the US to the way they look in Europe. In Europe, there's still a challenge, but of course, still significantly higher than, for example, Japan. So the inflation picture is playing out for a whole host of different reasons, and it's not clear that those reasons will necessarily respond quickly to interest rate rises, which suggests that maybe interest rate rises aren't always the answer.
Yeah, and you're pointing to the fact that actually, part of the reason, if not the majority of the reason, people think that there's so much inflation is, of course, because of supply shocks rather than, a healthy economy with much more demand. So do central banks need to adapt their language to communicate better with the markets, or how do you think this will play out? Like the market reaction to what the central banks are saying more than doing?
So I think there's two things that are really worth thinking about. I think central banks are really keen to manage our inflation expectations. They care more about our inflation expectations than they do about absolute levels of inflation. And I think you can already see that by the responses that there have been out there. The second is, I think there's a very close attention paid to real yields, because when you look at those long-term macro trends, very high debt levels, and a more challenging demographic, short-term lifts in inflation because of changes in demand pattern, because of changes in employment choices, and because of that supply chain disruption, they're all relatively short or at least cyclical issues against that very long structural shift that you've got going on with demographics and with high debt levels. And so I think it's the real yield that really the central bankers are most focused on, because it's if that rises significantly, certainly if it gets above zero, then you start to have a real risk of a very hard landing. And I don't think that is on anybody's roadmap. So as a central banker, I think that's what you're playing with right now. Get our inflation expectations down matters more than the absolute level of inflation today.
And so what does it mean for the markets, Anne? Is this the right time to bet on parts of the markets that could benefit from the end of the pandemic?
Well, I mean, end of pandemic, that's a really big statement out there. I mean, what do we mean by the end of the pandemic? Do we mean just adjusting to the fact that we're going to have ongoing waves over periods of time, and we need to get better at adapting to them? I think for what it means for markets is that I think central banks, if they see the inflation expectations maintained under control and they don't see real yields getting out of control, I think probably will be at the margin more dovish than the rhetoric today suggests, which means actually probably, although this volatility is likely to continue for some time, actually that's not a bad bedrock, because the worst of all scenarios is rates that rise too hard, too fast, and squeeze off what is quite a fragile economic recovery. I think the final point I would make is that there are parts of the world, and China is the most noticeable in that, where they actually, because they've taken a very different approach to the pandemic, they're looking for maybe easing rather than a tightening agenda, which you're seeing in other parts of the world. And we need to have space for both if we're going to keep the global picture of recovery and growth on track.
Is China actually, because of that loosening of policy at the moment, does it help the rest of the world in achieving some of their targets?
I think we need multiple different levers to keep the growth engine going. So if China can keep the growth engine going, it gives a little bit more of an umbrella and more flexibility, perhaps, for central bankers to adjust more dynamically what they need to do. But I think there are some signs that we're close to the peak in inflation coming. And I think, therefore, if you look at the different tools that central bankers have, there's interest rate hikes, there's tapering, and then there's actual balance sheet shrinking. They can pull on a number of different levers in order to manage the path from here. And probably they will adapt those levers according to the growth picture as much as looking at the inflation picture.
And we're spending quite a lot of time also on the surge in the cost of living in the UK, but also really almost in most places in the world. What can governments do at this point to try and help with that? And is the market ignoring it? Because we're focusing on inflation from a very economics point of view without really thinking about what it means for a lot of families.
Well, I think this is where it's separating what are short-term spikes versus what is real structural change. And I think, the energy is obviously one significant part of that. And I think there are interventions that governments can continue to target those for whom that is a significant part of their weekly wage bill. And obviously it doesn't affect everybody in the economy equally. So, I think there are specific interventions that governments can do about some of those big chunky things. But I think some of the other pressures that people are seeing in the immediate shopping basket, for example, some of those will play out because I think you're seeing increased demand in part because supply chain disruption has meant that people couldn't reliably get stuff that they need to. So you're seeing over-ordering, which is creating additional supply chain pressure. And as that supply chain pressure gradually teases its way out through the system, I think some of those pressures that we're seeing in people's baskets will filter out. Some are a little bit more longer term, for example, like energy. And that's where governments do need to look, I think, at the interventions on a country-by-country basis that are appropriate for that individual economy. And it will vary. As I said, Japan's inflation picture is very, very different to the UK's or the US's, for example.
And thanks so much. Anne Richards, there, Chief Executive of Fidelity International, stays with us, and we'll also talk a little bit about the UK and, of course, post-Brexit, what the city can do. Coming up, we'll have more of that conversation with Anne Richards. We'll also talk cryptocurrencies. This is Bloomberg.
The situation that our business leaders are facing, which is a large amount of uncertainty.
All eyes are centered on the post-pandemic recovery.
Before the end of this year, we'll get to a better place.
The Fed is going to move and begin to raise rates.
The question this year is going to be a constant sort of trade-off between whether the market believes that the Fed and the other central banks have really got the gumption to raise rates aggressively enough.
The U.S.-China situation does create, challenges for any company to find a pathway through that.
We may see some ups and downs because of temporary macro issues, but I think long term will be fine.
This year should be a better year than 2021 and 2020.
Well, some industry leaders there at the Bloomberg The Year Ahead conference discussing their outlook for 2022. Now we're back with Anne Richards, Chief Executive of Fidelity International. Anne, thank you so much for staying with us. When you look at 2022, and I want to focus a little bit on the UK, is there anything that the government can do today to try and alleviate some of those labour shortages that have been quite acute and pronounced in the last 15 months?
I think people have been making lots of different personal choices, again, globally, not just in the UK, about how and when they spend their time. And that includes how they engage with employment, with the workplace. Yeah. And it has changed it's not changed for everybody, but it has changed for quite a lot of people. So I think if we're thinking about how we encourage more people into the workplace, we have to think about what, as an employer, we spend a lot of time thinking about this, what is the proposition that you are offering to an employee? There's a piece around training and skills. Can we get better and more imaginative about the way that we train people to make it much more easy for people to self-select into the sectors, into the job vacancies, which they clearly are there, because we do have pockets of systemic unemployment at the same time as we've got these challenges with vacancies. So I think that's really important. And then how do we keep people in the workplace for longer? I think people now have much more appetite to work past what we used to think of as normal retirement age. How do we take people who've had career breaks? How do we make it easy for them, again, to skill up and get back in? So I think we've got to get really imaginative. There's no one single bullet on this. It's a whole range of different things. Government can do a bit. Employers need to be really imaginative and work together to create some of these mechanisms, as indeed we are doing.
Yeah, and Anne, you're also chair of Citi UK. What does Britain need to do differently to regain some of the ground lost because of Brexit? Is there a specific, point in which regulation needs to change to be more attractive for the UK?
Well, first of all, I should make really clear, I do not take over as chair of Citi UK until the 1st of June. So Mark Tucker is very firmly in that seat. And I'm not going to try and second guess Mark. But I think more generally, if you look at... No, it's okay. It's fine. I'm really looking forward to it. And one of the reasons actually is it's the first time somebody who's not from the banking, not from the insurance sector has chaired, which I think actually, to your question, it's part of the understanding that we need to think about the whole financial services ecosystem and how that relationship with the EU and actually with of course, much broader, international counterparts that we have, how that is going to work. And I think thinking about that interconnectivity is going to be, a crucial part for financial services. I think more generally, in the post membership of the EU world that the UK is now in, large companies, for the most part, have adapted pretty well and pretty quickly. I mean, there are still some challenges. I think everybody can see that, but it's been easier for them to do it. I think that the emphasis over the next year or two will definitely be helping the smaller and the medium-sized companies figure out how they navigate what is a different regulatory landscape, what is a different import-export landscape, and they don't necessarily have the resources and the capability that the larger firms do. I think that's one of the ways that we get through some of the log jams that we've maybe seen in the short term in this post-EU world that we've been navigating.
And when you look at central bank digital currencies, is there a risk that actually will be too late to it, given the pace of evolution in fintech in general?
Yeah, I think this is an absolutely fascinating area. And I think there's a lot of, in the supervisory and the regulatory and the central bank world, there's a lot of angst going on at the moment. To what extent do you let innovation go? To what extent do you need to step in and regulate? And is there a systemic risk that could build outside of the regulated sector, because in fact quite a lot of the innovation is happening outside of it. And so I think that the smart regulatory environments, the smart countries, will be thinking about how they create the ecosystem that doesn't just encourage fintech, that doesn't just encourage innovation, that also thinks in parallel what's the right way and a robust way to regulate that in a way that doesn't kill innovation, but makes sure that systemic risk can't grow outside what we currently think of as the financial system. And I think there is a bit of a risk of that at the moment. And it behoves, I think, regulators and supervisors really to get their act together and to accelerate a joined-up approach to this. So we don't just try and stimulate innovation, we get innovative about the right regulation that doesn't kill it, but encourages it safely.
And from next week, actually, the rules are changing about returning to the office. We heard that from the Prime Minister, Boris Johnson. How are you expecting that to play out at Fidelity, but also, more generally in your industry?
Well, of course, we've had different offices. We're in more than 25 countries globally. So, we've had some people back in the office, for months and months and months. We've had other people who've not been in an office for the best part of 2 years. It really does vary enormously depending on where in our world you are, but specifically for the UK, where we've got quite a large number of people, our offices have been open with a skeleton staff all the way through, but we will be encouraging more people to come back into the office, but very much observing the same kind of sensible protocols, because Omicron, yes, it looks like it's under control. The case load numbers are falling, but we're not through it yet, and we monitor staff sickness absences very, very carefully to make sure that we don't have an operational hit from that. So yes, looking forward to physically being back in the office again next week.
And hopefully in the studio very shortly. And thank you so much, as always, Anne Richards, our Chief Executive of Fidelity International. Now, coming up, loyalists rally around the UK Prime Minister Boris Johnson as calls for him to quit over breaching COVID rules grow louder. We speak to Camilla Cavendish, the former head of the Downing Street Policy Unit, next. If you have any questions for her, send them on IB Plus TV Go. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Boris Johnson has rebuffed calls for him to resign during a heated Prime Minister's questions in the UK House of Commons. Johnson was largely supported by party colleagues until former Brexit ally David Davies bluntly told the Prime Minister he should go. Well, joining me now is the former head of the Downing Street Policy Unit under Prime Minister David Cameron, Baroness Camilla Cavendish. Camilla is now a senior fellow at the Harvard Kennedy School. Camilla, thank you so much for joining us. Is this situation tenable? It seems that every couple of days there's a new Partygate, and we're still waiting for that report from Madame Gray.
So you can never underestimate Boris Johnson, but I do have to say I think the situation is untenable, Francine. He gained a bit of a reprieve yesterday because he gave quite a good performance in the House of Commons, and a lot of his own MPs were quite rattled by the fact that one of the newest intake defected to Labour. And funnily enough, even when MPs are manoeuvring against the Prime Minister, they don't always like outward displays of disloyalty. So I think now we're going to wait till next week. But Boris Johnson himself has tried to throw this forward to the Sue Gray report. And I think a lot of MPs are going to wait for that. But it's really hard to see how he will then survive much beyond that, because even if she doesn't find any criminal wrongdoing, it's then going to become impossible for MPs not to directly address the issue, which is, I'm afraid, it appears to be one rule for them and the rest for us. You know, we were all in lockdown. We weren't seeing dying relatives. The Queen was sitting alone at her husband's funeral while the Prime Minister now acknowledges, having previously said he didn't know about the parties, was indeed at one of the parties. And I'm afraid that just goes to the heart of this nation's concern with fairness, rightly.
But what's amazing, at least for me, Camilla, is that, so far there's been, almost absolute loyalty from the cabinet. Why?
Oh, I think in these situations you will always find none of those who would like to succeed him are going to be the first to come out against him. The Conservative Party is still spooked by what happened to Margaret Thatcher, of course. I mean, they got rid of her after she won an election. Michael Heseltine, who thought he was the right person to succeed her, came out against her, and of course the party rounded on him. So none of these guys want to be the Michael Heseltine. They're all going to wait. I think the real danger for the party, though, is the longer they wait, the more toxic the brand becomes. Because the truth is, it's obvious there were parties. It's obvious the Prime Minister knew about the parties. It's quite likely the Prime Minister authorised the parties, since the email invitation came from his own principal private secretary. His latest defence appears to be, no one told me that I was in charge. Well, I mean, that's not what we want from the man who's running the country. So I think either way, the party looks like a shambles, and MPs who leave it too long are going to be really, really tainted by that.
So, Camilla, is it because there's a faction of the party that actually still wants to make sure that Brexit is delivered, or is it because of how we're dealing with COVID? Like, what's the thinking?
No, I think people feel that Brexit is largely done, although there is a great deal of negotiation still to happen. But I mean, that's not reversible. Brexit is not going to be reversed in any way. I think now the concern of the Conservative Party is whether anyone apart from Johnson can hold together the electoral coalition that he built. So in 2019, he got votes from people, working class, largely white working class people in the north of England who had previously voted Labour. He got an 80-seat majority on the basis of this. They are quite concerned about who of his successors could hold that coalition together and win the next election.
Thank you so much. Beautifully put. Camilla Cavendish there, former head of the Downing Street Policy Unit under David Cameron. This is Bloomberg.
Central banks need to think very carefully, what can they achieve by raising rates?
It's appropriate, as the federal chairman, Chairman Powell, the Fed Chairman Powell has indicated, to recalibrate the support that is now necessary.
The Fed has to be in the Goldilocks approach. So when you're looking at it, 4 to 6 hikes is about as much as the economy can really absorb.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong on this Thursday, January 20th. Our top stories today. The global bond sell-off is on hold. Investors turn their focus to corporate earnings to measure the strength of the recovery. The White House tries to clean up after a Joe Biden misstep. The president risks undermining weeks of warnings to Russia with his wayward remark about Ukraine. And turbulence for U.S. airlines. Omicron forces United Air to cut capacity and warn on costs. Meanwhile, Netflix reports after the close with subscriber additions the main focus. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kailey Leinz and Kriti Gupta over in New York. Matt Miller is off this morning. And Kailey, it seems European equity markets, US futures diverging a little bit as we stall, as we pause on the bond market sell-off.
Yeah, and it was a really positive Asia when it or overnight session in Asia when it comes to the equity market, Anna. You have the MSCI Asia Pacific Index actually snapping a 5-day losing streak. It was up a little more than 1%. The real outperformance came from Hong Kong. The Hang Seng itself was up more than 3 percentage points, and that was really thanks to the outperformance of two groups in particular, technology and the property sector. The Hang Seng Tech Index up about 5.5%, and you had property stocks, the likes of Sunac, up more than 15% overnight. Of course, it in particular is benefiting from optimism around a wired payment for a yuan bond payment that was requested early, so maybe improving sentiment around that property developer. But by and large, what it really is underscoring sentiment this morning is the fact that you saw the second month in a row of a cut in borrowing costs in China, that loan prime rate being cut another 10 basis points by Chinese banks. So that's providing a little bit of support on the easier policy front. And just to check on the Chinese yuan, it is fractionally stronger against the US dollar this morning. Kriti right now sitting at 634.94.
Well, Kailey, a different story when you're seeing the risk picture in the United States, because futures, yes, they are higher, but some of those other cross-asset gauges are telling you maybe it's a little bit of a defensive rally this morning, a little bit of a mixed picture. Let me show you how. The 10-year yield, you are seeing that Treasury rally reverse, like Anna said at the top of the show. So yields coming down just a little bit. Some of that is simply because the Treasuries were oversold. Some of that is a little bit of geopolitical risk getting priced in. Crude, though, another major risk asset, down on the day, retreating from the highest levels since 2014. And lastly, Bitcoin, which kind of gives you that divergence with crude, another major risk gauge, Anna, and actually higher on the day. So it'll be interesting to see how equities open in just a couple of hours.
Yeah, absolutely. And Kriti, I can tell you how they're trading here in Europe, and it's not to the upside. We do see some negativity. We started out in positive territory, actually, across European equity markets, but retreating. Interesting you pointed out what's going on with oil prices, Kriti, because energy is one of the sectors in terms of stocks that's not doing so well today. Travel and leisure to the upside. I've got the euro to show you this morning just to check on whether it's moved on the inflation data that we just got coming through from the Eurozone. It came in exactly in line with expectations, so there's no anticipation of any move, and indeed, it hasn't really moved all that much on that. 113.50 is where we trade on euro dollar, that 5% print from the Eurozone. In terms of inflation, the market's gradually bringing forward when they expect the Eurozone, the ECB, to tackle inflation with a rate rise. Deliveroo, I've got a few corporates in here just to underline the point, Kailey, that we are really moving through into thinking more and more about the earnings season as we have that calmness in the bond markets. How long will that last? This is the picture on some corporates here. Deliveroo, it's a food delivery company based in the United Kingdom, but operates more globally. They gave an update to markets that went down well with investors. The stock moves higher. Unilever says it won't increase its offer for the consumer unit of GSK. That has gone down very well with investors. That stock was really under pressure at the start of this week when there was talk of it increasing its offer. And Valneva, the French biotech business, up by 20% this morning on some better news about its vaccine against Omicron. But it is a very volatile stock. It is not a vaccine that has been approved in major markets. And indeed, the stock price is not actually back to where it started out this week, just to give you the broader context, Kailey.
Well, Anna, we continue to watch those individual movers and idiosyncratic stories, but we're also watching the macro picture, and some of that is ahead today. Turkey's central bank will be making a policy decision likely to keep the rate on hold. That is coming at 6 a.m. Eastern time, so we'll watch for any reaction in the Turkish lira. Then at 7:30 a.m. New York time, we'll get minutes from the ECB's December meeting, and we'll get more data from the U.S., including initial jobless claims and home sales throughout the morning. And then, of course, it is earnings season. Netflix will be reporting its results at 4 p.m. New York time. All eyes will be on those subscriber numbers, ever important, and the stock's struggling so far this year. It's down about 14% year to date, Anna, and of course that comes in tandem with what has been some pretty brutal selling pressure for technology stocks more generally.
Yeah, interesting to see whether Omicron will be a boost to the likes of Netflix in the same way as it was a boost to the likes of food delivery companies and those stay-at-home plays over the festive period. Now, let's get back to the markets. The S&P dropped on Wednesday, failing to reverse Tuesday's rout, fueled by surging Treasury yields. The rout pushed the Nasdaq Composite over the threshold into correction territory. Bloomberg's Danny Berger joins us with a look at the market technicals. And Danny, are you getting any clues, any sense as to whether we're done with this correction on the Nasdaq is enough or whether there's further to go?
Well, it's certainly today's pre-market action so far suggests there is some dip buying. But regardless of direction, it does show us that we are on the precipice, that these are going to be an important few days because of these technicals. And look, I know a lot of folks out there aren't the biggest fan of technical analysis, but sometimes you just have to respect the price action. As you were saying, we've seen the S&P 500 close below its 100-day moving average. The MLive team has been excellent on this MLive Go on your terminal. Mark Cudmore pointing out that over the past 19 months, you've never seen this drop more than 0.2% below the 100-day moving average. So folks out there might take this as a buy signal. But if they don't, look out below. It is a big drop. We're seeing the same thing on small caps as well. The Russell 2000, another technical sign, cropping up there as well. It's bumping up against its long-term resistance. It's bumped up against its long-term resistance 6 times so far this year. Cameron Kreis, our macro man himself on the MLive blog, also points out that if we break below this level, you could see a lot of damage come into the market, Critty.
Yeah, Danny, let's just talk about technicals when it comes to the bond market as well, because there's a lot going on in the equity market. I love technicals, by the way. I'm a big fan. Talk to us about what's going on in the space of yields.
This really has to do with options. Critty, I am diving into the wonkery of wonkness here, so just bear with me for a moment. 127 is what Andy Brenner over at Alliance calls the swoosh moment for markets. Essentially, there's a lot of open interest around options, put specifically at 127 on Treasury futures. $32 billion to be exact. At the moment, we're not there yet, so this is an out-of-the-money position. But should we get to this level, all of a sudden you have all of these dealers who need to hedge against this newly in-the-money position, and they'll do so by selling Treasury futures. So estimates are that we could see yields pop up to potentially 2% for the 10-year should we hit 127 on the futures.
All right, Danny Berger, Bloomberg's official wonkery correspondent, thank you so much.
I'll take
and
it.
Let's turn from the markets to politics, because today marks 1 year of the Biden administration, and the president is beginning the 2nd year of his term with the collapse of his bid to push voting rights legislation through a divided Senate, and now turning the focus in Washington back to Build Back Better. Listen to what the president had to say when he addressed the country yesterday.
It's clear to me that that we're going to have to probably break it up. I think we can break the package up, get as much as we can now, and come back and fight for the rest later.
Jack Fitzpatrick, Bloomberg government reporter, joins us now from Washington. So, Jack, he's looking to potentially break it up. What parts of this package are most likely to find support in the Senate, specifically for moderates like Manchin and Sinema?
So the president outlined yesterday, he thinks there's pretty significant support for the roughly $500 billion in spending on energy, environment, climate measures that's in the bill. He also is pretty confident there's support for the pre-K education measures and also on the tax measures that would pay for at least that limited extent. But outside of that, he said, and other Democrats have started to indicate, there is enough of an objection to the child tax credit so that is probably not going to make it. Overall, he essentially painted a picture of a bill that would probably be measured in the hundreds of billions rather than the trillions. It would be much, much smaller than anything you've heard about, certainly than what passed the House before, but could be pretty significant on the energy and environment front. They could try again in a separate bill following up on that, but they do at least have a couple things that he mentioned that Democrats think the moderates could get on board with and probably get through a 50-50 Senate.
So, Jack, we moderate our expectations domestically, perhaps. President Biden also talked about the international agenda, about relationships with Russia, and, of course, the tension on the Ukrainian border. It's caught a lot of people's attention that he seemed to be contrasting a full invasion with what he called a minor incursion. Jack, how has this gone down in Washington?
So there was immediate pushback from Republicans on that and criticism because he said there would not be the same kind of sanctions for a minor incursion in the context of having mentioned an invasion. He later had to answer a follow-up question on that, and the White House had to put out a statement saying that he essentially was referring to if there's something like a cyber attack or the fact that the U.S. government believes there are already some covert forces, Russian forces, in Ukraine. That's what would not draw such significant measures from the U.S. But clearly, that's the kind of risk the president runs, speaking somewhat extemporaneously on foreign policy. There's a foreign policy risk for any miscommunication, and also an electoral risk because Republicans are criticizing him for what came across as a bit weak on the possibility of an invasion into Ukraine.
All right, thank you so much to Jack Fitzpatrick of Bloomberg Government in Washington for us this morning. And from D.C. to the skies, an estimated 62% of the U.S. aviation fleet is approved to perform low-visibility landings at most airports without fear of interference from 5G mobile phone service. That's according to aviation regulators. And we spoke to Willie Walsh, IATA Director General, an airline, of course, trade group, yesterday about this 5G issue. Just take a listen to what he had to say.
The fact that we're not back up to full speed gives airlines options that they probably wouldn't have had this happened in 2019. If this had happened during peak times, it would have been a nightmare for airlines. So we really do need this issue to be addressed before we see an even greater ramp up in long-haul international travel.
Let's get more on this with Sardar Phillip, who covers airlines for Bloomberg News, who's in London. So maybe this could have been messier, Sid, but it still hasn't been a very easy situation as it's unraveled. Are we anywhere closer to full and final resolution on this issue?
No, we're not yet near full and final resolution. Most Airbus and Boeing planes have now been cleared for most low visibility landings because the FAA has determined that their radar altimeters have the ability to withstand 5G signals. But regional jets, which make up about half the fleet in the US, still hasn't really been addressed. So that's still a major issue at the moment. And we've seen the airlines, especially from Asia, canceling flights on the 777, but they've now brought them back since the FAA move.
Sid, talk to us a little bit about how this is going to affect the bottom lines of a lot of these airlines at a time when they could really use every traveler that they can get, every flight that they can get, every piece of cargo that they can transport. Of course, we're expecting to hear from American Airlines in just a couple of hours on how their fourth quarter did. How much of this is going to eat into the first quarter of 2022?
So the 5G issue is one of the many issues affecting the airline industry. I mean, Omicron's obviously the much bigger problem for the airline industry. We had United coming out yesterday saying that Omicron is going to make them cut their forecast. I mean, they previously forecast above 2019 levels, but now they're going to be below them. So essentially, the Omicron and the resulting impact on business travel and leisure travel is really affecting them, along with staffing costs.
Yeah, and we're seeing United Airlines shares down about 1% in early hours as a result here in the U.S. Thank you so much to Bloomberg's Sardar Phillip. And now let's take a look at some other stocks moving in pre-market trading here in the U.S. One mover to the upside is Novavax, of course, the COVID-19 vaccine maker. Those shares are up about 2.4% after getting provisional approval for its COVID-19 vaccine to be used in Australia. Another mover to the upside is Alcoa. It reported results after the bell yesterday, and maybe no surprise, it is benefiting in a big way from surging aluminum prices. That led to a big boost in the company's profit. The CEO says he sees more demand coming, and as a result, that stock is up about 2.3%. One mover to the downside, though, is Ford, potentially heading for a third day of losses. It's already lost about 11% over the last 2 days. A lot of concern about inflation, higher prices on the cost side, the supply side weighing on this stock. It's down another 2.5% before the bell this morning, Anna.
Yeah, really interesting to focus on the earnings stories as we go forward. What companies have to say about pricing power and how that plays into macro concerns around inflation. Kailey, coming up on the program, then we'll get into a conversation about the markets with Lucy Baldwin, Citi Global Head of Research and Equity Advisory. How resilient can stocks be if we do resume that bond sell-off? Then we get the view from Standard Chartered. We speak with the chairman of that bank, José Vinals, will join us a little bit later on in programming. What's his perspective on inflation and the fight against it? Plus, later today, we'll speak with the United Airlines CEO, Scott Kirby, about their plan to cut capacity. We were just talking about aviation with Sid Phillip here in London. That's 12:30 p.m. in New York, 5:30 p.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Kriti Gupta in New York today. Anna Edwards is in London. Matt Miller taking the day off. And that means I get to bring a chart. And for our radio audience, I will explain it to you. It's really quite simple. It's looking at the relationship between technology stocks and yields. I have the NASDAQ 100 in white on this chart, the 10-year yield in blue. And we can see that as the NASDAQ 100 has gone down, the 10-year yield has gone up. On the bottom panel, I have the correlation between those two, which is growing more and more positive, which basically indicates they are moving more in tandem. Granted, that correlation coefficient is still around 22, so by far it is not perfect, but yet it indicates that as we are seeing continued pressure on the bond market, it is leading to continued pressure in technology stocks. Let's bring in Ben Rahm, cross-asset strategist for Bloomberg Markets Live, who joins us now. Obviously, a lot of selling pressure for both of these asset classes. Ben, how much further downside could there be to come?
Morning, Kelly. I think there's got plenty of more downside. Before I pass the mechanics, I mean, this correction could turn into a bear market, could turn into a full-fledged bear market territory. Why do I say that? Because of two factors. One is rising rates, which is the correlation that you put up there, and forecast earnings. If you look at the NASDAQ 100, and if you assume an index earnings of about $635 for this year, if you add those two together, and then that's the basic framework. Against that framework, you extrapolate you bring in the 1 year, 2 year rate, which is now around 165 or thereabouts. And then you work in a Z spread. And that Z spread, based on my estimates and my model, is around 325 basis points. If you mix all those together, what do you get? That implies a drop of another 10% for NASDAQ, for NDX. That's pretty alarming, I agree. But the fact of the matter is we have front-end yields rising vigorously this year. And if that earnings estimate is going to be 635, I do think that we are in for a bigger drop here.
Okay, so that's a bigger drop for tech stocks then, Ven. Good morning to you. You've been writing a piece about treasuries, though, and what the Fed's next moves will mean for treasuries. And you talk about the cha-cha-cha. What does it mean for treasuries to go cha-cha-cha if the Fed prefers to keep the romance, Ven? Explain.
Well, I mean, we had Christopher Waller saying last week on Bloomberg that, look, the Fed is not going to raise rates by 50 basis points in March, even though some in the markets are positioning for that kind of a move. Now, if the Fed prefers that it doesn't want to surprise the markets, it just wants to go in 25 basis point sequence, then the markets are going to move in fits and starts, like we have seen this in the past week. I mean, the real rate pushes up and then comes back down. So it's one step forward, 2 steps backward kind of approach. That is not going to really quell the market's fears about inflation. Whereas if they did a 50 basis point move at one go in March, that sends a loud message to the market saying that, look, the Fed is in the business to quell inflation, and they mean it this time. And that will set a cat among the pigeons in the markets. And that is what perhaps we need. If they don't do that, it means a slow dance in treasuries, and that's why I meant cha-cha-cha. But if they do a 50 basis point move, that is a quick step dance that we want. And I do think that what is it that the Fed wants to deliver here? Do they want a cha-cha-cha, or do they want a quick step?
Okay, do they want to set the cat amongst the pigeons to just mix our metaphors even more? Ven, thank you so much. Ven Rahm of Bloomberg Markets Live, thank you very much for your analysis this morning. Remember, you can get plenty more analysis with all the metaphors from the Markets Live team. MLIV Go, that is the function to use on your terminal. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Kriti Gupta in New York and Anna Edwards in London. Matt Miller is off today. Now let's get the first word news. And President Biden's bid to push voting rights legislation through a divided Senate has collapsed. Democrats Joe Manchin and Kyrsten Sinema broke with their party to kill the bill's chances. The president says the measure may need to be broken up in order to get any part of it through Congress. For the second straight month, banks in China have cut their borrowing costs. That's after the central bank cut policy loan rates and pledged more easing to stabilize the economy. The one-year loan prime rate was cut by 10 basis points to 3.7%. The UK is 2 months away from a brutal cost of living crisis. Inflation just hit a 30-year high of 5.4%. The Bank of England is raising interest rates, and a cap on domestic energy costs is expected to rise by 50% in April, just as the government raises taxes. Calls to lessen the worst impacts are growing. And an NFT startup co-founded by pro football star Tom Brady raised $170 million in a round of funding led by investors Andreessen Horowitz and Kleiner Perkins. The company, called Autograph, partners with athletes to create digital collectibles. So maybe a win in business for Tom Brady. We'll see if he can get a win against the LA Rams in the playoffs this weekend. Before we can get to the weekend, though, we have to finish out this week of trading. It's been brutal, but we are seeing a rebound taking shape, at least when it comes to U.S. technology. Today, we'll discuss the markets and more with Lucy Baldwin, Citi Global Head of Research and Equity Advisory. From New York and London, this is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kailey Leinz and Kriti Gupta in New York. Matt Miller is off today. Here is what you need to know. There's a pause in the global bond sell-off. Investors have turned their focus to corporate earnings to measure just how strong the recovery is. It's a bumpy ride for U.S. airlines. United says Omicron will delay a recovery in air travel this year. It's cutting capacity. We'll get earnings from American Airlines before the opening bell in New York. And shares of Netflix down 14% in 2022. Will today's earnings report after the bell boost the price? Analysts will see if U.S. price hikes have an impact on subscriber growth. That is a look at what you need to know this morning. A lot of focus then on the earnings stories, Kriti, whether that's the Netflix numbers later, the aviation numbers a little sooner than that. What do we have to focus on ahead of the market open?
Yeah, Anna, let's just talk about whether or not people are showing up to buy the dip, especially in the tech space. You are seeing a little bit of defensive positioning, even in the future space. The S&P 500 futures up 0.4%. But if you were to look at the NASDAQ futures, up just shy of 0.7%. So once again, that defensive nature right at the start of pre-market trading. And you're seeing that kind of in the cross-asset trading as well. A little bit of a bid for yields as well, kind of pricing in some of that geopolitical risk. Also really responding to that pretty extreme sell-off that we've seen in the past couple of weeks. Crude, another major risk gauge, under a little bit of pressure. Once again, retreating from the highest levels that you saw in 2014. The big kind of divergence that you're seeing in that risk picture is, of course, Bitcoin, higher by 1% on the day, but still pretty muted considering the one standard deviation move is just 4%, Kailey. It's important to keep in mind, does this actually translate into what you're going to see at regular trading?
Yeah, a great look at the macro picture there, Kriti. I also want to take a look at the micro picture because, as you both mentioned, earnings really are front and center this week. Of course, we got some from United after the bell last night. The fourth quarter results did beat expectations, but a little bit of pessimism coming in when the airline said that Omicron is going to mean capacity is going to be more muted in 2022 than previously expected. So as a result, that stock is down about 1%. Of course, we're awaiting American Airlines later on this morning. Ahead of those results, that stock is positive by about 1%. And by and large, you are seeing a bit of a rebound taking shape in technology stocks after really 2 rough days of selling to start the week. Right now, Tesla is up about 1.64%, and even Apple moving higher to the tune of about 0.5%, Anna.
Yeah, and Kailey, if it's all about a rebound in tech stocks, then that doesn't play well for European names, of course. European equity markets just still under pressure this morning to the downside on most of those major markets. No great moves in FX markets, at least as far as the euro dollar is concerned, 113.45. Just markets digesting that final reading on European inflation, Eurozone inflation being confirmed at 5%. Goldman's suggesting to me earlier on it's really about that core number we need to focus. Deliveroo, talking of earnings stories, this is a food delivery business, reported numbers earlier on this morning. That's going down well with investors. Omicron acting as a bit of a boost to that kind of stay-at-home sector. Unilever says it won't increase its offer for the GlaxoSmithKline consumer products business. That has been well received by investors. And Valneva, this is a French biotech. It makes, of course, an as-yet unapproved vaccine against COVID-19. Better news on their vaccine against Omicron. And that sent the shares surging, although it is a very volatile stock. It's not actually back to where it started off this year. Kailey?
All right, well, Anna, let's get back to the equity markets more broadly. Joining us now is Lucy Baldwin, Citi Global Head of Research and Equity Advisory. Lucy, we've seen some pretty significant moves already in 2022, some serious technical breaches on both the S&P 500 and on the NASDAQ. Do you think the worst of the selling pressure is over for now? Will dip buying take hold?
Good morning. Thanks for having me. Well, look, I think to really address that, you always need to step back for a minute and think about what we and others are expecting for this year. You know, we're looking into this year as a continuation of the global recovery. So we're looking for just over 4% global GDP growth this year, pretty broadly spread across the world, at least from a DM perspective, a bit more mixed in EM. But, you know, we have got some really big pressures mounting, which is obviously what the markets are reflecting. You know, firstly, the pandemic, is it going to become endemic quickly enough? Secondly, surging inflation, which I'm sure we're going to dig into today, given it's such a hot topic, excuse the pun. And then, of course, thirdly, it's policy, and i.e. the tightening of policy that we're seeing. You know, our view is you get 4 rate hikes from the Fed this year. We've been calling and expecting to see a pretty aggressive tightening for a while in response to those inflation rates. And so really those things I think could obviously derail that kind of recovery we're seeing. When you then map that back to equity markets, our core view is that you've come off a year where you've just seen around 50% earnings growth. You know, we're expecting to only see high single digit earnings growth this year from the corporates around the world. And so that's obviously a headwind, particularly when valuation is as high as it is. The US market's trading up at 22 times. So we've been underweight, for example, big parts of the tech sector for a little while now on that basis. So we'd expect to see some pressures still there. I mean, we prefer parts of the market like financials as an example.
Okay, so that's the sort of the caution on the tech names. Lucy, good morning. As we look ahead to, and we're sort of in it already, earnings season, very much in it, I suppose, for some sectors, but it's gaining momentum. When we hear about pricing power, should we see that as a comfort? It might be a comfort to investors in individual names, but it might raise concerns around inflation and how broad the breadth of inflation that we're seeing. How do you respond to those kind of messages around pricing power from the corporates that you cover?
Yes, so our analysts will obviously look to see which companies can pass through inflation effectively or not. And you're right, you have to think about, you know, inflation from the context as to, you know, where are we going from here, right? It's going to be about the delta. And when you look at a lot of the inflationary pressures that we've seen over the last, you know, 6 months or so mounting, whether it's commodities, whether it's supply chain or around labour, we expect to see quite a lot of these really starting to moderate. So, you know, our analysts will obviously be listening and probing to see where those changes are coming through, but particularly around things like, you know, labour, we're expecting to see some changes as we go through in terms of, you know, the work from home dynamic shifting back. We expect to see that mix of goods versus services shifting back in favour of more services as things normalise and vaccination rates work and climb around the world, etc. And so, you know, also, you know, we expect to see some people returning back to the labour market that have been out. A lot of those factors we think will start to improve inflation, albeit, you know, we're probably still in for a sticky month or two, particularly when you look at things like energy and commodities. You know, we've got a slightly different view on where energy prices are going to go in terms of things like the oil price. Near term, you could easily go from 90 to 100, given we're in winter and it's obviously very tight supply. But longer term there, we really think you'll get supply coming back on from the US, from OPEC, and that we think is going to mean that prices actually come off in oil, for example, quite rapidly, more likely to see a bear market, we think, there this year, for example.
Lucy, we've got a couple minutes without talking about the Fed, which is, I think, probably a first on Bloomberg television. Let's just talk about the 50 basis points that a lot of people are speculating the Fed might hit the market with, or the U.S. equity market at least with, in March. But that's not actually what the bond market is pricing. They're only pricing 27 basis points. What would a 50 basis point hike look like for the stock market?
Yeah, look, I think to sort of continue that start of the conversation around tech stocks, all of these high growth, high multiple stocks are going to really struggle to absorb that, we would suspect. I mean, that's not our base case expectation, but, you know, we'd expect to see those parts of the market really struggle to absorb it. And so, you know, for us, we would be encouraging people to look for more sort of value segments around the world, value markets like the UK, markets like Japan, we really like here because of those concerns and the risks that are clearly mounting there around that as the Fed tries to grapple with these very high inflation rates.
I'm really glad you mentioned Japan in particular, but I want to go to China for a second because the zero COVID policy was one of Eurasia Group's top risks for 2022. It's something that a lot of people are talking about, given that those supply chains actually extend into Asia. How much of that policy, or the failure of adhering to that policy, I should say, will reflect in the supply chain issues and therefore the equity market?
Yeah, our expectation is that you do start to see some of these supply chain pressures ease. I think, as you say, China is going to be complicated for a number of reasons. We're expecting about 5% growth out of China this year, same again the following year. They're obviously much more focused from a policy stance of protecting and limiting the downside rather than trying to chase the growth that they've seen in the past from a GDP perspective. So, although we've seen some very, very high inflation rates, PPIs, etc., we're expecting to see that start to moderate. And as people start to get back to work, vaccination rates start to climb, people start going back to the ports, etc., we're expecting to see some of those blockages ease and start to move things through. And we think that, there are definitely good signs of that around the world as well.
Lucy, thanks so much. Thanks for joining us. Lucy Baldwin, Citi Global Head of Research and Equity Advisory. Coming up on the programme, Standard Chartered's chairman joins us, Jose Vinals. Stay tuned for that conversation. This is Bloomberg.
The situation that our business leaders are facing, which is a large amount of uncertainty.
All eyes are centered on the post-pandemic recovery.
Before the end of this year, we'll get to a better place.
The Fed is going to move and begin to raise rates.
The question this year is going to be a constant sort of trade-off between whether the market believes that the Fed and the other central banks have really got the gumption to raise rates aggressively enough.
The U.S.-China situation does create, challenges for any company to find a pathway through that.
We may see some ups and downs because of temporary macro issues, but I think long term will be fine.
This year should be a better year than 2021 and 2020.
Industry leaders there at the Bloomberg Year Ahead conference discussing their outlooks for 2022. Let's add another voice and get the outlook of Jose Vinals, chairman at Standard Chartered Bank. Jose, really nice to speak to you. Thanks so much for joining us here on Bloomberg Television. We were just listening to some voices there talking about inflation and inflation concerns. When you talk to clients about inflation, Jose, what is the nature of those conversations? How concerned are they?
Well, thank you very much, and great to be here today. When we talk to clients, they are concerned not only about inflation, but also about the reasons why there is inflation. And particularly for international clients, they're concerned about inflation coming through disruptions in global supply chains, supply bottlenecks, which is making life more difficult for them. They're also concerned that those increases in things like commodity prices and food prices, increases in imported prices, may not only affect goods prices, but also services. And therefore, that at the end, this may have an impact on wages, and this is something that may compromise their profitability. So I think that it is in the interest of the world economy for inflation to be kept under control. And from that point of view, I very much welcome the attitudes of central banks and the guidance that they are providing, that they would do whatever is required in order to keep inflation stable.
Okay, so do you think then, Jose, that we need to see bold and aggressive action from central banks to really get that message through to investors and to markets? Because the ECB, for example, is very much behind in a sense of when it will get to its first rate hike compared to the Fed.
It all depends on what the dynamics of inflation are in specific markets. I think that we have a global phenomenon and we have some regional differentiation. The global phenomenon is, yes, that due to a number of reasons having to do with the recovery in demand and also these supply side disruptions, we are having a higher inflation. Then the question is, what is the perspective? For example, in the United States, I think that with inflation having hit 7%, I think the Fed is right, looking at other indicators and at the tightness of the labor market, to think that it is time to start sort of giving some forward guidance regarding interest rate increases. And the members of the Federal Open Market Committee have already signaled that in their deliberations that they contemplate 3 hikes this year. Markets are pricing 4 hikes. I am more on the lesser than the more hikes in terms of my expectations, but I think there will be some hikes, and that is something which is entirely reasonable to bring inflation back into control. In the case of the euro area, for example, I think the situation is different. I think that the economy is not at full employment yet. There is more spare capacity, and if you look at the forecasts of the ECB, I think that they sort of contemplate some reduction of inflation going forward. So I think that a more gradual approach to withdrawing monetary accommodation is warranted. So I would not be in favor of anything sudden or drastic, but I think that some gradual withdrawal in different areas, depending on where they are, I think that's reasonable.
So how high do you think rates will ultimately get, Jose?
Well, it depends, and it's going to be different in different countries. If you think of the major economies in the world, I think that interest rates are going to be higher in the United States than in the euro area. And if you look at the other very large economy, which is China, what you can see is a very different prospect for interest rates. Interest rates are being cut, contrary to what the expectations are in advanced economies. And this is something which is going to lead to a monetary policy differentiation, which is going to have consequences for foreign exchange markets going forward.
Jose, this is Crete in New York. We've talked about the Fed, we've talked about the pandemic, but something we don't talk about enough is, of course, geopolitical risk. What is the bigger risk for you? Russia, Ukraine, US, China, the energy crisis in Europe. What are you watching?
Well, we watch everything because at the end we live in an integrated world and everything has repercussions. But for us, the China-US relations are particularly important because we derive a very significant part of our earnings from Asia. It is actually the largest contributor to our overall revenue. And we have been following and navigating the uncertainties in the relationship between these two superpowers of the last few years. And I can tell you that this requires some skill, it requires prudence, but also we take a very professional approach. And what we think is that there are opportunities that come with some of the challenges. And we have been helping our clients to sort of redirect their investments, to diversify the global supply chains, we have been a constant force in favor of global trade. And I think that, some of the bilateral tensions in global trade between the United States and China have led to more trade between the United States and other emerging markets and between China and other emerging markets. And we have been there in order to help our clients and make sure that things go in the right direction.
Jose, so you're very familiar with the way that the handling of Omicron, the handling of COVID is being done very differently in different parts of the world, of course, and you're managing a global business in that context. Here in the UK, where I am, we've just seen announcements this week that suggest that the work from home mandate has gone away. Are you bringing people back to the office? Are you telling people from tomorrow, from today, come back? What's the suggestion in the UK?
Well, yes. What we're telling our people is that given the government's, if you think of the UK, given the government sort of announcements, yes, we are telling people that they're free now to come back into the office. Before, only those jobs that were considered to be essential and that needed to be performed from the office were coming to the office. But now we are consistent with the government guidance, and then we expect to have our colleagues come into the office. And I think that's something that would be very helpful, because you miss a lot of this sort of continuous human interaction in those spontaneous moments that arise from time to time. So I think that that's something which is going to happen as of next week. On the other hand, we are in for the hybrid mode of working, meaning that not everyone, even in normal times, has to come back into the office every single day. So we have asked for our employees to give us our wish list in terms of how would they like to work. We have also looked at what are the needs of the organization in different business in different areas, etc. So we have provided for flexibility. And I'm very happy to say that this is something which is remain consistent with productivity going very well, and also with higher employee satisfaction. So it is a hybrid way of working that we will continue to embrace, but now we'll make it more of a reality because people would also be able to spend time at the office.
Yes, a hybrid model that actually involves office time. Jose, thank you very much. Thanks for joining us. Good to speak to you. Jose Vignals, the Standard Chartered Chairman. Thanks for joining us here on Bloomberg TV. Coming up on Bloomberg Markets, Brian Moynihan, Bank of America Chairman and CEO. That's at 10 a.m. New York, 3 p.m. London time. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Preeti Gupta in New York and Anna Edwards in London. Matt Miller is off today, but very much in. Tom Keene, co-anchor of Bloomberg Surveillance. He's joining us now. Tom, we have earnings, we have politics, we have economic data. What catches your eye this morning?
We got lots of distractions, Kailey, and what I'd really focus on is the same damn chart I had last Thursday. Let's do it again. This is claims adjusted for the growing population of America, and this is the chart President Biden likes best. This is the recovery of the Biden presidency. He'll take credit for it. We're down to some form of stasis, but Kailey, it's remarkable how we are back to where we were February of 2020.
Making a round trip. Thank you so much to Tom Keene, co-anchor of Bloomberg Surveillance. Of course, we're getting those jobless claims at 8:30 a.m. Eastern time. And as for what else we're watching today, I am watching Netflix earnings, those coming after the bell. And as always, it's going to be subscriber additions. That really is the number to focus on. The Street looking for 8.3 million in the fourth quarter. That's actually a little bit below Netflix's own guidance of 8.5 million. And then, of course, speaking of guidance, the outlook for the first quarter, especially as you're seeing price hikes here in the U.S. on subscriptions, is going to be key to watch. This is a stock already down 14% year to date, Creedy. So these earnings either could be a positive catalyst or mean further downside to come.
Yeah, Kailey, you're watching airline earnings. You're watching Netflix earnings. I'm watching airline earnings. Just coming up in a couple of hours, United reporting last night that it's actually cutting its 2022 capacity. A lot of that to deal with those labor pressures and those larger costs that they are dealing with. Nevertheless, let's see if American Airlines follows in the same trajectory. Of course, in the pre-market, you are seeing those shares up 1.2%. So a little bit more optimism in the airline space this morning, Anna.
Kriti, I'm going to be watching some geopolitics with a keen focus on what's going on with Ukraine, the tensions on the Russia-Ukraine border, of course, front and center. We heard from President Biden overnight. How difficult are his comments going to make the job of Secretary of State Anthony Blinken? He is in Ukraine today. He is in Kiev. And so how will he deal with that minor incursion comment that we heard from President Biden? How will that go down with European allies? We heard from Ursula von der Leyen of the European president. She was talking about wanting dialogue with Russia, the Commission president, of course, and suggesting that massive sanctions would follow if we see further aggression from Russia. And if there were to be an attack, Europe would be prepared. These were the comments coming through from Ursula von der Leyen, the European perspective just in the last half hour or so. More Bloomberg Surveillance is ahead. We'll hear from Brian Deese, White House Director of National Economic Council. Among others, he'll be interested in that chart that Tom was just showing. We'll get to all the earnings stories as well. This is Bloomberg.